Good morning, viewers. It's Tuesday morning, April 29, 2025, and I'm your host, Sunil Thakkar, a Sunny Talks Money. Welcome to ST Money 7 a.m. early morning news, where we provide you the latest, concise, and precise stock market wrap with accurate figures and numbers. The Dow Jones Industrial Average overcame a midday swoon to close higher for a fifth straight session on Monday, extending a relief rally underpinned by optimism that trade deals are in the offing. The blue chip index ended the day with a gain of 0.3% or about 114 points. The S&P 500 rose less than 0.1% after wavering between gains and losses throughout the day. Both benchmarks finished with their first 5-day winning streak since late 2024. The Nasdaq Composite slipped 0.1%. Treasury yields fell. The 10-year yield declined to 4.213%. Bitcoin prices stood just below $95,000. How much has trade turmoil hit the economy and corporate earnings? Investors will get some clue this week with monthly jobs report and data showing how fast the economy grew in the first 3 months of this year. The monthly jobs report for April, due Friday morning, could give a glimpse of how Trump's trade war is affecting the labor market. The US economy likely added 130,000 jobs, according to economists, down from the 228,000 that were added in March. In the coming months, a large chunk of S&P 500 companies is set to report results from the first 3 months of 2025. In all, 180 S&P 500 companies are set to report earnings this week. While the quarter ended just before President Trump's Liberation Day tariff announcement on April 2, investors will pay close attention to whatever corporate executives say about both present conditions for the businesses and the road ahead. The most important questions on earnings calls are going to be the trends throughout the end of the quarter compared with the quarter as a whole, as well as looking for any guidance changes. Stocks rebounded last week as the Trump administration softened its stance on tariffs and signaled a readiness to negotiate trade deals. On Monday, Treasury Secretary Scott Bessent gave mixed signals on trade, just as investors prepared for a big week of corporate earnings that could shed light on how the trade war is affecting the US economy. Besson said during an television interview that China should be responsible for reducing trade tensions, given they sell 5 times more to us than we sell to them. But he also said many countries have put forward trade proposals and that negotiations with Asian trading partners, particularly India, were going well. For equities to keep rallying, investors would need to see how the White House followed through on the dovish pivot to a trade with China. Four of the Magnificent Seven large cap tech companies are planned to report results this week: Amazon, Apple, Meta Platforms, and Microsoft. Apple's reliance on its Chinese supply chain will be particularly scrutinized. Google parent Alphabet posted strong quarterly earnings last week, but warned of coming headwinds from the end of the de minimis trade loophole. The exemption for shipping lower value goods is due to end Friday, which could dent Alphabet's digital ad revenue, primarily from Asia Pacific retailers. Shares of chipmaker Nvidia, another Magnificent Seven stock, fell 2.1% on Monday after a report in the Wall Street Journal that China's Huawei is developing a new artificial intelligence chip that it hopes could replace some higher end Nvidia products. Other companies reporting earnings this week include bigger consumer facing brands such as Coca Cola, McDonald's, and Starbucks, as well as car maker General Motors, credit card giant Visa, and oil majors Chevron and Exxon Mobil. The focus this week will be on how much this tariff stress has hit real world decision making. The key word here is tariff stress, not tariff costs. No one is yet talking about the actual tariff costs to hit the bottom line. A 2.4% gain in Boeing shares helped keep the Dow in positive territory after Bernstein raised the aircraft maker's stock rating and price target. Spirit Aerosystems shares advanced 2.6% after Airbus reached a deal to take over some of the company's plants. My take: corporate guidance is based on tariff stress, not tariff costs. The impending impact of higher costs from the administration's trade policy is making it very difficult for the corporate world to forecast how the year will play out as consumers brace for economic pain. Companies with direct impact from tariffs are generally being forthcoming, providing guidelines that incorporate the full brunt of both blanket and reciprocal tariffs. Several analysts are souring on the profit outlook due to the risk of an economic slowdown, with the US benchmark's earnings revisions breadth or estimated upgrades versus downgrades approaching downside extremes. Certain companies are front running the tariffs. The good news is that companies are protecting their earnings and margins, and investors will be happy about that. Markets have swung wildly in recent weeks in response to comments and social media posts from Trump administration officials about trade. While the worst fears of trade war fallout haven't been realized, there's still substantial concern about how Trump's tariffs will affect the economy. With the jittery April near a close, several market pros see little reason to think volatility is in the rear view mirror. Executives are uttering words like chaos and insanity to describe the tariff turmoil. Is it that they don't understand the tariff world? This is where there remains a fair amount of headline risk. And until that is clear, corporate guidance will be based on tariff stress and not tariff costs. And that's the wrap for today, my dear viewers. And if you got value from this, please do subscribe, like, and share this video as much as possible. You can contact me at st@st-money.com for any further information. I'll see you again tomorrow morning. In the meantime, happy investing, stay inspired, and remember, it is all about money.